Imagine, you're in your second year of retirement, you don't yet need to touch the money in your 401k or IRA because of cash you set aside when you retired. And now you've just met with your accountant, and with no income, this year you owe very little, if anything, in taxes. Great news! Or is it? Stay tuned. When little or no taxes is a big red flag coming up. This is Jeff Drayton, Certified Financial Planner Professional and founder of Jeffrey A. Drayton Financial Planning and Wealth Management, LLC. If you're watching this on YouTube, go ahead and subscribe. And if you're viewing this from my website, fill out the sign-up form at the top of the blog page so that we can contact you when new content becomes available. You know, every now and then I get the chance to first speak to someone right about the point when they are approaching age 70. 70, or more specifically age 70 and a half, is a bit of a milestone in retirement income planning. Up until that point, you are allowed to let the money in your tax-deferred retirement accounts such as a 401k, traditional IRA, 403b, and the like, stay in those accounts and continue to produce investment returns with no tax consequences whatsoever. It is all tax-deferred, which is to say, as long as the money stays in the account, meaning you do not make a withdrawal, thereby taking a distribution, it just keeps growing, deferring the taxes until some point in the future. But at age 70 and a half, the party comes to a bit of an end. At that point, you will be forced to start making withdrawals in what are called required minimum distributions, commonly referred to as RMDs. RMDs are just the government's way of saying, we've been waiting to tax this money for a long time now, and we think enough is enough. And taking that RMD is not just Uncle Sam's friendly suggestion. The penalty for not taking an RMD that you should have is 50% of the RMD that you failed to take. Meaning, you were supposed to take an RMD of $20,000, but you didn't. You now owe the government a penalty of $10,000, 50% of the distribution that you failed to receive. So what does this have to do with a little to no tax bill being a big red flag? Well, plenty. But to know exactly what, there are two things we need to understand. The first is, every dollar that went into your tax-deferred account pre-tax, which is generally most, if not all, of the money you contributed to your traditional IRA or 401k, has a tax bill associated with it, waiting to be paid. That balance you see in your account is not the amount that you will get to spend. It is the gross amount prior to you paying your taxes. Just as during your working years you received a paycheck that had both a gross amount and a net, the amount from your tax-deferred accounts that you will actually get to spend still needs to be determined once we net out the taxes that you will owe. Which then begs the obvious question, how much is that going to be? Well, unfortunately, that's hard to say, and it is actually the second thing we need to understand. We need to have at least a basic understanding of how these taxes are determined. Here it is worthwhile to at least have a general understanding of how your income taxes are calculated each year. We in the United States have a progressive tax system. This refers to the fact that as you have more and more income, your earnings are taxed at progressively higher rates. Now, there are actually a number of ways that income that you receive can be taxed. However, the one that is applied to money that is withdrawn from a tax-deferred retirement account is simply ordinary income tax. And for that, the progressive tax brackets are applied. Here's how that works. So let's take a married couple, John and Susan, who are filing jointly. I'm making this video in 2019, and for their 2019 taxes, it means these tax brackets will be applied. Together, John and Susan have $185,000 of taxable income. First off, they need to calculate whether they will itemize their deductions or take the standard deduction. John and Susan are going to take the standard deduction, which, for married filing jointly taxpayers, is $24,400. Therefore, the first $24,400 of their $185,000 of taxable income, they actually pay no tax, or a 0% rate. For the next $19,400, they pay taxes at a 10% rate. The next $59,550, they pay 12% taxes, then 22% taxes, and so on and so forth. It turns out the highest rate of taxes that John and Susan will pay is 24%. We call this rate their marginal rate, which is the highest rate of taxes that any portion of their income will be taxed at. Sometimes I hear people make a comment such as, "I need to be careful not to make too much money this year. I'm in danger of going into a higher tax bracket." That comment seems to suggest the idea that going into a higher tax bracket will then mean that all of their income for the year will now be taxed at a higher rate. No, that's not how it works. That portion that went into the higher tax bracket, however much that is, that will get taxed at the higher rate, but it will have no effect on any of the earnings below that. Those earnings still get taxed at the same rates that they were being taxed at before. Do you notice something about these tax rates? For the most part, they go up by fairly modest amounts, a couple 2 or 3% each bracket. However, that's not always true. There are a few big jumps. The one that is most noticeable is the jump from the second to the third tax bracket, from 12 to 22%. That's a pretty hefty increase. As a matter of fact, those first two tax brackets, 10 and 12%, are actually quite attractive rates to be paying. One of the advantages we generally think of in earning investment returns in a non-qualified investment account, which is to say an account that is not specifically for retirement, is that the earnings in that type of account often qualify to be taxed as capital gains. And the capital gains tax rate that applies to the majority of people is 15%, which of course is less than most of the ordinary income tax brackets. But it's not less than all of them. The first two tax brackets, 10 and 12%, even beat capital gains rates for most people. So hopefully it is now becoming clear why not paying taxes in the early years of your retirement might not be such a good idea. There are 2 points to be made. Point 1, every dollar that went into your retirement accounts tax deferred has a tax bill that is going to need to be paid sooner or later. And point 2, if you take the money out in years when you do not have a lot of additional income, you might very well be getting those taxes paid at one of the lower rates towards the bottom end of the tax brackets as opposed to one of the more onerous rates up towards the top. Often in financial planning, we look at a 10 or 12% tax bracket as a terrible thing to waste. And remember, once you reach the age of 70 and a half, those required minimum distributions will start kicking in, and your ability to control the rate at which those distributions are recognized will now be limited. A few last things to note. First, simply taking a distribution from one of your tax-deferred retirement accounts does not mean you have to spend the money. It simply means that you are removing the money from that retirement account and recognizing that distribution as income and paying the taxes in that current year. What you do with those dollars after that is entirely up to you. It could go into a non-qualified account where possibly the earnings would qualify for capital gains tax treatment, or there might be even more advantageous options. The thing to understand is this: once you have reached the age of 59 and a half, you are eligible to begin taking distributions on those tax-deferred accounts penalty-free. At that point, whether or not it might be a good idea to do so is a conversation I would highly recommend with your, hopefully, certified financial planner professional. I'm Jeff Drayton. Thanks for watching. Hey everyone, as always, nothing in this video is meant to be specific advice for you. Advice like that can only be had by working with a financial planner, someone who knows you and your situation. I would encourage you to seek out someone who is a certified financial planner. This is signified by the letters CFP with the registered trademark sign following his or her name. I would also encourage you to work with a fee-only financial planner. Now that's 2 words, fee-only. Not fee-based, not fee plus commission. Both of those terms mean that the planner or advisor can receive commissions and is therefore not free of the conflict of interest inherent to commission sales. Again, I'm Jeff Drayton. Thanks for watching.